All right, let's talk Home Depot. They just dropped their Q3 earnings, and wow, the market's reaction was severe. The stock took a nosedive. So, what on earth happened? We're going to unpack the numbers that really spooked investors and figure out what it all means. So, to really get this, we've got to start with the market's immediate verdict. Honestly, it tells you just about everything you need to know about how this quarter was received. A 6% drop, and that's in a single day. This wasn't just a little dip, folks. It was Home Depot's biggest one-day loss in over 2.5 years. And to give you some perspective, this move was way bigger than what options traders were betting on, which means it caught a lot of people by surprise. A genuine shock. So what exactly triggered such a massive sell-off? Well, it all comes down to this really weird disconnect. On the one hand, you had sales, the top line, which actually came in a little bit better than Wall Street expected. But, and this is the important part, the real story was in the profits, and crucially a lowered forecast for what's to come. That's what investors hammered.
Okay, let's roll up our sleeves and really get into the weeds here. We're going to break down the key numbers that drove all of this negativity.
First up, the bottom line, profit. The adjusted earnings per share came in 10 cents shy of what analysts were calling for. No, this wasn't just a one-off thing. This marks the third quarter in a row that Home Depot has missed on this key number. You can see how that kind of trend would start to wear on investor patience, right? And here's the number that caused all the head-scratching. Net sales at $41.4 billion actually beat the forecast, but just barely. This is why the report felt kind of mixed at first glance. But as we saw, the market looked right past this tiny win. Now, comparable sales basically flat. 0.2% growth is next to nothing. And what's even more telling is that management said these numbers actually got worse as the quarter went on. They even turned negative in October. That is not the kind of momentum you want heading into the end of the year. And that weakening momentum is really part of a bigger picture. If you look at this table, you can see the pressure building. See that adjusted operating margin? It's getting squeezed. And while the average shopper spent a little more each time they came in, it didn't matter because fewer shoppers were coming in at all. Simply put, customer traffic is down, and the company's just not getting the same bang for its buck. So, how did the top brass explain all of this? Well, they pointed to a couple of things happening out in the world, these external headwinds, while also trying to remind everyone about their big, long-term plan to win over the professional contractor. Their main reason? A lack of major storms. Things like hurricanes usually drive a ton of repair and rebuilding business, and that just didn't happen. On top of that, you've got the sluggish housing market that we all know about, and just a general sense of caution from consumers who are thinking twice about those big, expensive projects. But this right here is their grand plan for the future. They are aggressively buying up companies like SRS and GMS to build out what they call a pro ecosystem. The goal is to become more than just a giant hardware store. They want to be a one-stop shop distributor for professional contractors, which is a huge and very lucrative market. But here's the thing. The market on earnings day was in absolutely no mood for excuses. Investors pretty much ignored the short-term explanations and focused like a laser on the company's future earning potential, which right now looks a whole lot weaker. Just look at this chart. It really puts things into perspective. Over the last year, Home Depot's stock is down 16%. Meanwhile, the broader sector, other companies that sell non-essential stuff, is up a massive 23%. So this isn't just a tough economy story. This is Home Depot itself lagging way, way behind. And this really gets to the core of it all. That small revenue beat, it didn't matter. What mattered was the guidance cut. The company now expects earnings to drop 5% for the full year. That projection completely wiped out any good news and sent investors running for the exits. So, with all that context, let's turn to our forward-looking analysis. How does all of this shape our call on the stock from here? So this is really the million-dollar question for anyone looking at this stock, right? You've got these very real economic pressures pushing down on the business today, but you've also got this compelling long-term strategy. So what's the right way to be positioned? So here's our take. We are initiating coverage with a market perform rating. Look, the company is doing a great job executing on its big pro strategy. You can't deny that. But these headwinds from the housing market and a stressed out consumer are very real, and they're probably not going away anytime soon. It all adds up to a pretty balanced risk versus reward profile right now.
Now, for anyone looking for a more tactical idea, a pairs trade here is really interesting. You could go long consumer staples, think toothpaste and toilet paper, and go short Home Depot. The whole idea is a bet on that consumer trade down that even management hinted at. As household budgets get tighter, people will keep buying the necessities, but they'll put off that big, expensive deck or kitchen renovation.
And of course, as always, please remember that this analysis is purely for informational purposes. This is not financial advice.